The 2024 forecast centers a lot around supply and demand. Most prices are determined by supply and demand, but more than ever, real estate, as well as the direction of interest rate this year, will be focused on supply and demand. Let's begin with inflation because it's a big driver of interest rates. As we take a look at inflation and where it stands at the beginning of the year, the core CPI number is at 4%. The core PCE number, while this is mainly what the Fed looks at, is at 3.2%. So CPI is the consumer price index and PCE is the personal consumption expenditure number. The Fed wants this personal consumption expenditure number to get to 2%. That's its target. But in the December Fed meeting, there was a major pivot. The Fed finally came out and said, hey, we're not going to wait to start cutting rates. We're not going to wait for the core PCE to get to 2%. We're going to start cutting rates somewhere before it gets to 2. Now, when asked about it, Jerome Powell didn't give an exact rate where he'd start cutting, but we could start handicapping it. And let's take a look at the direction of where we think inflation will go. So much of inflation numbers are based on shelter or rents and owner's equivalent rent. So what do they look like today? Well, if you take a look at blended rents, they're going up at 2.5% year over year. So you can see that they went up, and now they've come down from their accelerated levels. But they're still going up, although just at 2.5% a year. New rents are going up at about a negative 1% a year, so they're actually coming down. But renewal rents are going up at about 4.5% a year. So when you blend the two together, the overall rate is about 2.5% per year where rents are rising, and that's a lot less than where it was. The problem is that the Fed doesn't look at what we're doing currently. The Fed takes the last 12 months and averages them. On top of that, people could have signed an extended lease or a lease in advance, and the Fed's data collection is a little bit wonky. So you have a very long lag, and it's evidenced here by the way the Fed looks at it in this gold line. And you can see here was the peak, but much later on, we got the peak here, started coming down here, started coming down here. So you can see that these numbers lag, but eventually start getting to a similar location. And that's kind of where we are today. We are seeing the Fed looking at these numbers, but we really are much lower. The weighting within inflation reports is rather significant, in fact. In the CPI report, the shelter, it's 44% of it. On the PCE report, it's 21% of it. So there's an enormous overstatement here then. The difference between these two is rather significant. And when you take the mathematical difference, let's say CPI at 4% difference, apply it by the weighting, you'll see that there's a huge lag effect. And when we take into account the lag between both CPI and PCE and apply that to what it would really be today, well, you'd be looking at a much closer rate to the Fed's target of 2.2, 2.3%. And in fact, if you look at what the last 6 months or the run rate for the last 6 months, and we know the Fed does look at that, it's actually below 2%. It's at 1.85%. So these are important numbers. So the trend in inflation is working in our favor, and it means that the Fed is going to have to look at cutting. So what can we look forward to in the upcoming CPI report or PCE reports, knowing that shelter has such an enormous bearing and weighting? Now, the way it works is you get a new number, and the next report that we'll get for shelter and CPI will be released January 11th. That's for the month of December 2023. That's going to replace the number that was December 2022. And as you can see here, here's that number, and it was a pretty high number. And by the way, the PCE number for this year will be released January 26th. So this high number will likely be replaced by a lower number. See what we've been trading here since June of last year. It's been around 0.4%. So if we get a number of roughly 0.8% and replace it with 0.4%, you can see we get a pretty strong benefit there. And that will be again happening in the months of January and February, which we'll see in February, March 2024. So the first quarter of 2024, the releases that we should get on inflation should be quite favorable. We should see inflation come down. Now, after that wonderful first quarter, it gets a little harder to make progress. We could make some progress, but it'll be a little bit more grudgingly. We should make quite a bit of headway in the first quarter. That means better inflation numbers, and the market should like that. Now, what would that mean as far as what the Fed looks at? Well, let's take a look. The current core PCE, again, this is the one that the Fed most closely watches, is at 3.16%. So how does the math work on that? Well, on January 26th, we get the December reading for core PCE for December 2023, and we're going to estimate it's going to come in 0.1%. Big reason for that is because I showed you we should make a lot of headway on those shelter costs. The same thing for January and February. So we know that this area, based upon what I just showed you in shelter, we should see relatively low numbers. But take a look for the rest of the year. What we've done is I've just plugged in 0.2%. It's a reasonable estimate of what we might get. So the way it works is that we get the new number, it replaces the year on overall core PCE from the previous year, which was 0.39. And in this example, you can see 0.01 is lower than 0.39. It's lower by 0.29. So if you subtract 0.29 from the current reading, what do you get? You get 2.87. So 3.16 minus the difference between these two is 0.29. Means that core inflation should be 2.87. It's below 3. It's in the 2s, but it's not quite close enough to the Fed's target, I think, for them to take their position and start cutting. And the next Fed meeting that will occur will just be 5 days after, on January 31st. While I think that they'll like the number, I don't think they'll be ready to cut just yet. Let's take a look at what they'll see by their March 20th meeting. We'll see a reading of 2.47. I think that this might just do the trick. A reading under 2.5, the Fed said they're going to start cutting before we get to 2. I think there's a good probability March 20th we'll get the first Fed rate cut, and certainly by May 1st. As you can see, we'll be under their target here, so they may overshoot. Stay tuned to part 2 as we talk about the Fed, the balance sheet, and the odds of a rate cut.